Hi, I'm Seth Freudberg. I'm the Director of Options Training here at SMBU in Manhattan, and I'm also the head trader on SMB Capital's Options Trading Desk. So today I'd like to talk a little bit about strike selection on iron condors. Iron condors, as you probably know, are a short bearish call credit spread combined with a short put credit spread, which is bullish. And those two combined basically bracket the market around the price of a particular stock or index. And the idea is for the market to behave, stay inside that range, and then you get to collect both your call credit spread as well as your put credit spread credits and keep those in your account. So let's take a look at a way you can think about selection on iron condors as far as your short strikes, and specifically the points you want to stay away from. So let's take a look, for example, at the SPX, which since February of this year, 2015, has been neatly channeling between around 2035 and 2135. So this is the S&P 500 index. So this provides a pretty straightforward example of where you want to put your strikes and where you don't want to put your strikes. And basically, the idea is to stay away from adjustment points on a trade being key support and resistance levels. So all this year, once the market gets into that 2035, 2040 area on the SPX, it seems to bounce off of that level, and at the same time, the market's been having trouble getting past the 2130 level on the SPX, and so those provide pretty obvious support and resistance areas for the entire market since February. So let's suppose that you wanted to place a trade this morning. Today is Wednesday, July 15th, and suppose you wanted to place a trade this morning, which would be an iron condor for August in the SPX options. So what I'd recommend is that you try to place your put strikes below the obvious support level in the market, and that would be that 2030 level we were just talking about. So in this case, since the market has actually channeled from 2039 has been the low since February. So if you put your short strike at 2030, the market would have to break through its support, and you want to give it a little bit of room. So I'm giving it 9 points of room in this example before you would hit your short strike on the put side. The same would be the case on the call side. The market's been having trouble getting past 2130. In this example, we've actually put our short strike up at 2160. So that gives you a 30-point resistance break to the upside. Now, why do you want to stay away from key support and resistance points? One of the points is obvious, the other one may not be so obvious, and that is if the market hits and bounces off of a support point, then obviously if your adjustment point was at the support point, it may not have been necessary because if you're going to adjust, in the case of an iron condor, the adjustment would be to roll that credit spread farther away from the market. So in this case, you'd roll the credit spread down on a support break. On a resistance break, the same thing. You're going to be rolling rolling the trade upwards. You roll your credit spread upwards. Well, if the market has what it's been consistently doing since February, bouncing off of both its support and resistance levels, then you don't want to adjust there, because then that adjustment would prove unnecessary. Every time you adjust an options income trade, it hurts your income on the trade. So in the perfect world, you don't adjust at all. The second reason is a little more subtle, and that is when the market hits a key support or resistance level, there's a panic that ensues, and if that panic occurs, if you try to roll your credit spread at that point, you and everybody else in the world is trying to do the same thing. So you want to stay away from those points so you stay out of that panic. What happens in panic pricing in the options market is the prices spike just when you don't want them to spike, because you're taking short options, you're rolling them far out of the money. If the short options are spiking in price at that time, you're going to pay a fortune, and that will basically cripple the trade for the remainder of the trade. So Two reasons you want to stay away from key support and resistance levels are: one, the adjustment may not be necessary, and very importantly, because if you get caught up in a panic, you're going to pay a fortune to roll that credit spread, and you may just destroy your trade. So keep away from key support and resistance levels and save yourself some money on adjustments. Thanks very much, and we'll see you next week.